welcome to another week of Real Estate with Soul. Um, During these lives or during these videos, what I'd like to do is I'd like to bring on mortgage professionals who are in the industry, who are movers and shakers, and I want them to come on and kind of give their perspective of what's happening in the market. So today I have Andrew Thompson. Andrew Thompson he's from New Jersey, but he's somebody that I've known for a hot minute. So I wanted to have him on so we can talk about the brutal truth about the mortgage lending business, man. Welcome to the program, Drew.
Thanks, brother Khalid. Appreciate you having me on today.
Nice, man. Nice. So we want to hop right into it, man. We kind of had some technical difficulties as far as getting in here. But now we're here, man. So let's talk about this topsy and turvy real estate market, man. Why don't you tell, well, before we go into that, why don't you tell people about yourself, man? What did you do before becoming a mortgage lending professional, and how'd you get into the business?
Oh, it's wild. So before I was a mortgage lending professional, right before I was actually running two warehouses. I was a sugar manufacturing warehouse manager, running a couple of facilities. And prior to that, I was in sales. I was a store manager for AT&T back in the day. And kind of got out of it via one of my customers that I had. They, gave me the opportunity with the warehouse and everything like that. And kind of had a difference of opinion with the owner of the company that I was working for at the sugar factory, and needed to get out. Fast forward, it was kind of I'll say divine intervention. My father needed uh, some assistance getting back and forth to his doctor's appointments. He was sick at the time, and he passed a year later after I took the time off to kind of help him assist him. And after that, I saw a course to get my mortgage license. I did the research. I was kind of debating between becoming a real estate agent or getting on the lending side.
Mhm.
And in my research and everything like that, I found that the lending side was a little bit more in depth. I was able to help more people on the financial side of things. Had a little bit more avenues for me. So that was my decision to get into the lending world, and I haven't looked back since.
That's interesting that you were looking at becoming a real estate agent and a lender, and
Yeah.
was just like, all right, I'm going to take the lending side versus the agent side. I guess what kind of turned you off from the agent side?
Nothing turned me off per se from the agent side. I was in a position where I wanted to make sure that when I was getting into the career, I wanted to make sure that I was setting myself up for the future. So if I got into the financial side of things, there was a couple different avenues I could take as far as having my license. I could go work at a bank, and have other avenues and streams of income come in based off of, and I could always get my real estate license later on down the road if I decided that lending wasn't for me. But at heart, I like to help people by nature. And at the time, the people that I was running into, even my own family members, were having issues qualifying for mortgages, or they were having issues keeping up with their mortgage payments. I even had family members that were losing their homes because
Wow.
they of mistreatment during 2008 or years after. So it heavily influenced my decision to go into that side of it because I wanted to understand it to better help them.
Gotcha. Now, was it easy for you to find something? Because just take us through it. Do you get your license and then you kind of get put on with somebody? Because that's when you get your real estate license, you get your real estate license first, and then you find a place to hang it at. Is it the same way with being a lending officer?
So it was wild. It was almost like a little bit of divine intervention again. I saw the course, and I took the course. And while we were inside of the course, they were having a job fair for, the financial industry at the end of the course. Not through the same course that I took, but it was in Mount Laurel, New Jersey. So went to the job fair, and one of the companies that I ran into there was Freedom Mortgage. And they were having a program they used to run. I don't think they do it anymore. It's called the Fast Track program, where they're looking for professionals that have been in regular industry for a long time, that they are making the transition to the mortgage world, that they help them get their license and get on their feet and everything like that. So I was already in the process of getting the license, so they were like, you're kind of perfect fit for our program, and I got a job almost instantly after, I got my license.
Now, with being an agent, I mean, most brokerages, they're just looking to throw as many people up against the wall and see who sticks. As far as an agent, there's not a whole lot of requirements and it's pretty easy. I always tell people there's more hours to be a hairdresser than it is to be an agent. So a lot of brokerages, they're just bringing anybody with a license in, and if you stick, you stick. Is it kind of the same thing with the lending world?
It's twofold. So the place that I started out in was a call center. So, of course,
Mm,
they vet you. They want to make sure that you can handle the volume that you're going to throw at you. They want to make sure that you're competent enough to talk to people on the phone. But not everybody makes it through. That's why they had the fast track program at that company, because they wanted to put people through a training program enough to make sure that they were responsible enough to handle being on the phone and dealing with people's personal information. Now,
mhm.
on the other side of that, there is the outside world, which I'm in right now, not in the call center. And on the outside world, as long as you have a license and you tell them you have a will to, make money in the industry and the will to help people, they will put you, out there and throw you to the wolves and see if you
Right.
stick. Which I see a lot of companies, do. They will hire as many people as possible because their mindset is, if I can get as many agents out there as possible, just like the real estate world, the more market share I have in this market, the more people are going to
Right.
hear our name and will become a household.
Right. Mind share. Still there?
You still there?
Okay. There we
Yeah.
go.
Oh yeah.
Yeah,
So
you froze for a minute.
Oh, sorry about that. So they want to get as much market share as possible as far as getting their name out there. So if you have 40 agents or 40 loan officers in the tri-state area that are all touting your name out there, you're going to become a
Right.
household in that area. So they will do that in the outside world. Inside, again, they want people that are going to go after it and kind of be drones and just make calls every hour on
Mhm.
the hour to get to touch as many people as possible.
Like a boiler room type deal.
Yeah, yeah. I believe you, and it's funny. So a couple of weeks ago, I think you had a one on one of my other colleagues, Shot Hammond.
Yes.
That's where I met him. I met
Oh,
him.
wow.
Great guy. Shout out to Shot.
Right.
Awesome lender. But we met in the call center. We were both in
Okay.
in there, grinding it out on the phones and everything like that. So a lot of us, you cut your teeth in there, but it's a completely
Right.
different world when you come to the outside world, and you have to self source all your business. You gotta build your own book of business. There's nobody telling you to get up in the morning and go after it.
Right.
There's nobody telling you to be good to people. You gotta. It's a totally different beast.
Now, when you first got into the industry, of course, there's a underrepresentation of minorities in the field. I guess, how did that impact your situation? I guess just starting out, did that play a part at all?
So when I first started out in the call center, no, because again, we're in a call center. The people that are on the phone really don't know who you are. But
Right.
when I started as an outside agent, as an outside loan officer, is when I really saw the differential in treatment. Um, with the way that people in general and real estate agents will treat you as a
Mm,
minority in this business.
mm,
And you'll see, again, I'm sure you can attest to this. The real estate world is very clicky, in
mm,
the aspect of, if you're in this circle or if you're in this crowd or in this minority set or in this culture set, then you're okay. But it's very hard to kind of break that stigma, because again, people already have a reserve in talking to find people about their finances in general. So
right.
also break down the barrier of being a black man. Also break down the barrier of being a large black man that sometimes can be
Right.
look intimidating and stuff like that.
Right.
It's and some people don't want that image on them. When you're looking to deal with certain agents, they're like, all right, well, my clientele doesn't cater to that look and image. So
Mm,
I'm not. I'll show face and I'll say play nice with you, but I'm not going to send you any business because that's not my clientele. That's not what I want to put in front of my clientele.
okay. Yeah, I guess I never thought about it like that. I mean, there would be no reason for me to think about it like that, but, um,
Mm,
that I never thought about that as far as individuals with the loan officer, like, okay, I'm not going to, pick this particular loan officer or throw him any business because of his physical presence or the way he looks. But again, um, I have no reason to. I can,
you
but I,
you be
now that you're verbalizing it, I know that somebody else could look at it like that.
Yeah, you'd be surprised, man. I had a real estate broker tell me one
Mm,
time. He was like, "Listen, man." He's like, "I'm not gonna lie to you." He's like, "I need a black guy."
mm,
He was like, "I'm not gonna lie. I need a black guy." He's like, "The neighborhood that I'm in." He's like, That's what we have here." He's like, "And if I go and door knock in this neighborhood, these people aren't going to be receptive to me. They're going to think that I'm the law or something like that. So I need a black guy. I need a black face." And I knew what he was talking about, but it
right,
sucks that again we have to be in that environment, And again, that was one of the cornerstones for me to realize, that's just the nature of the state of the world that we're in. Not
right,
everybody's going to want to deal with you as a minority, but then there's some people that are going to need you.
right, right. It's kind of the pendulum swings both ways, but sometimes I feel like it swings more the other way
Oh,
as far as
absolutely, absolutely.
versus we need a black guy. So,
Hmm.
no, that's and I guess now that you're seasoned in the business, and I guess not so much the clients, but in the lending circle itself, do you see any type of disparaging treatment from lenders with other minorities per se? Because and I talked to Robert Farmer about this last week. Is that
Hmm.
you'll see a lot of clickbait out there on the news where they'll
Hmm.
say blacks are 3 times as likely to get denied for a mortgage, or you'll
Hmm.
see I think in Pennsylvania 60% or 70% of whites own their homes, where only 30% or and maybe lower than that, maybe 20% of African Americans. And most of it is pointed toward the lending side. I guess
Uh-huh.
when you see these statements, what comes to your mind?
What comes to my mind is when I get applications from people that have been turned down by other lenders, and I say, why didn't they just tell them to pay off this credit card?
Mm,
It'll boost their credit score,
mm,
and we can get you some down payment assistance so you can buy a home. Something
right,
as small as that. I've had
right.
clients come to me with a 580 credit score, which is qualifying for
Mm,
FHA,
mhm.
with $40,000 in the bank, and been turned down by other lending institutions
Wow.
because they said their credit score was too low. And again, know the lending institution well, so I know they accept them.
Right,
Was the credit history a little bit shaky? Yes, but it wasn't nothing that they couldn't mitigate.
right.
So it's the effort that I see on the minority side of things that troubles me, because those statistics are true, because they will quickly throw a minority application to the side
Mhm.
if there's a sight of that's going to be either a hard file for me, or eh, I don't feel like dealing going through the trouble of helping these people um,
Gotcha.
on that side of things. Now, again, on the other spectrum of it, there's guys out there that only see green. So they're like, I'm helping everybody because I got to make a living for my family. But there are,
Right.
again, just because I've seen again and there's no other demographic I see it from. So like when I get
Mm,
applications in from, people that are white or, Latino or anything like that, when I get applications in from they've been denied by other lenders, I see why they have denied them. Yeah, they didn't go the extra mile to tell them how to get approved, but they had
mm,
extreme circumstances why didn't get approved. Most of the
Okay.
time, when I get applications from other races, it's because they're shopping the rate and they want to see,
Mm.
if I can give them a better situation or something like that. But never because I got denied by this guy or he told me I had to bring I was going to need $30,000 to close when they're only approved for a $200,000 loan that might only run them $16,000 $17,000.
Okay. Okay.
You know what I mean? So it's the subtleties again that people are like, oh well, that's not racist. They just didn't do extra work. Why are they only not doing the extra work with our people? So
Right.
that's
Right.
the troubling side of on the lending side of things. Even dealing with other lenders or going to different events and stuff like that. Being in certain offices. Being if you're not in an office that with other black lenders or black other loan officers, again, the treatment isn't the same. They might not
Mm.
invite you to certain events or hey, we had X, Y, and Z at the office. Oh, I didn't know nothing about it.
Mm.
Those type of subtle things happen in the industry that a lot of guys just really don't talk about because they're like, that's just how it is.
Inclusion.
Yep, yep,
Inclusion. Yeah, that's why I always tell people, man, even during my first time home buying seminars, is that at the end of the day, you got to find somebody that cares because
yes,
that's what it's about. It's about caring and going the extra mile because you can turn down a loan for a number of reasons
yeah,
and deny it and keep it pushing. But taking the time to dig, okay, we need to fix this. Okay, we need to fix this. Yeah, it takes time and it's not a promise of a payoff because you can fix it and the loan can still not work. But you got to
yeah,
find somebody that cares about your situation
1,000%.
versus becoming a number. And I have a lot of people intuitively they'll go down to their bank. So they'll say, okay, well, I've been banking with uh I don't know, Main Street Bank for 20 years. So since I've been banking with them, then yeah, when I'm going to get a mortgage, I should go down there also. But I tell them, hey, Main Street Bank is great at checking and savings accounts. But when it comes to loans, what's going to happen is they're going to ship you off to a call center in Idaho, and then people are going to treat you just like a number because you essentially are a number to them,
Yep,
versus letting me refer you to some folks that the connection here is that they want to do a good job for you because they want me to send them more business. So now it makes somebody that cares for you, even though you don't know this person from a, you know what I mean, from a can of paint.
yeah, that's 1,000% true. 1,000%. And again, you've dealt with enough lenders to know which ones care, which ones don't, and you know, again, I don't have anything against banks. Sometimes the bank could even be better, but again, those ones that ship you off to somebody that doesn't care, or you talk to the loan officer one time and then you're with eight other people and you don't know what's going on.
Right,
you know,
right.
it's great that they have all those hands in the pot, and but again, a person gets confused and they get lost in the sauce because nobody's caring. There's not one person caring about that one person. It's eight people caring about a particular part of that person. So they don't get a whole experience.
Right. And then most of them are just punching the clock.
Yep.
So if it's not done by 4 o'clock, they out.
Yep.
And you don't get them on the weekends. You can't get them after 4 or 5 o'clock. You're not getting nobody's cell phone number during business hours. If they there, then they're there. If they're not, they're not. And there's nobody that actually there's nobody that actually cares about your situation. But like I always say, there are like you said, there are some good banks. I'm just talking about the platform. The
Yeah.
platform in itself. If you have grade A credit score and you got a bunch of money in the bank, and I mean you're just straight up and down as far as a great candidate, then the bank may be good because you won't have any issues. But that's not 90% of the population. 90% of the population has some kink in their armor per se, to
Oh
where
yeah.
they need some finessing, man. So let's go to let's move on to the current market. Okay. The
Okay.
current market, we're going into the spring season here. We're not in spring yet, but we're going into the spring season, man. I guess what have you been seeing lately in reference to loan applications?
So it has been indicative of the interest rates in the market. Um,
Mm,
we had some relief in the first, couple months of the year, couple months of this year, where the rates
mm,
trickled down a little bit. We kind of peaked at that, 5.99, area in the market, and then some data came out with the Fed and the job report,
right,
and all those things directly affect the financial markets and everything like that, and inflation. So when those reports came out, the rates have kind of going back up. So when the rates were trickling down, there was a spike in applications because there was more affordability in the market for people that were kind of squeezed out of the market in the end of last year because rates were in the 70% range. So,
right,
we were seeing, we saw, a decent spike in applications for a while. And then they kind of cooled off because, people, again, because the rates rose last week over the last couple weeks. There's some
mhm,
people that either have been um, priced out of the market again, or that they have um the affordability is not there for a price point that they're looking for. I get people in that are looking for $130,000 properties because that's what they can afford. And there's not a ton of them out there in the market. You might find one, but it needs a bunch of work, or you might find that diamond in the rough that somebody could actually get into. But from what I'm seeing, I mean, this week has been pretty. People are still looking. I will tell
right.
you that people are still looking to get pre-approved, and they're still looking to start the home buying process because rent is at an all-time high. You know,
Indeed,
rent is
indeed.
ridiculous right now. So people still need to get out of the places that they're in. Leases are coming up. So people are still looking to buy. The caveat is not a lot of people are looking to sell. The people that are
Right.
looking to sell have a necessity right now. They either have to move elsewhere, they need to upgrade, or they need to downgrade. They're
Right,
not.
because people got them awesome interest rates, man. They got that 2.2 and 2.9. And
Uh huh.
listen, I got an Upper Darby property where could I sell it? Yeah, make a pretty penny of it. Yeah. But man, I got a 15-year 2.65 interest
For
rate.
what are you selling that for?
Right.
Besides to buy it and invest in something else. But even if you invest in something else, unless you're buying it cash, you're gonna be at a
Right.
detriment on a rate.
Makes no sense. It makes no
Yeah.
sense. So you got a bunch of properties. And what's crazy is that the Fed, I mean, I don't know if you heard what the chairman said, the last thing he said, but I mean, he's on a tear that they're trying to get inflation back down to, I think he said around 2% a
Yeah.
year.
Yeah.
And I mean, he's on a mission and the
Mm-hmm.
economy. So you're seeing the economy blaze forward, but it's like in order for rates to come down, you almost got to see things get worse. But you don't want to see things get worse because you know what I mean? Like the State of the Union.
Yep, and that's the so it's the battle that we're fighting, in the mortgage world, because again, we kind of need those rates to come down. We either need rates to come down or wages to go up, for people to have more affordability and for the rates to make sense. Because 7% for somebody making interest rate for somebody making $15 an hour doesn't make sense. A lot of times, unless again if they're paying a $3,000 a month rent payment, all right, we can do it, but it sucks for them because they're not going to be able to get as much house. I could do a loan today, at 6% for somebody, that could have bought a $500,000 house 2 years ago or a year ago when the pandemic at the height of the pandemic, we were giving out the 2 and 3% interest rates, but they're only qualified for 300 and some thousand now. It's all relative to, again, the market that we're in. So again, prices have increased. They say that we've cooled off, but not as much. It's not to the point where we're, oh my God, these houses are so cheap, let's go buy them up. because we
Right.
haven't dropped off that much. We've gotten back to pre-pandemic levels.
Right.
So because the prices have increased, the economy hasn't faltered or anything like that. They're not seeing a dip, in the jobs report enough to where they're like, all right, well, you know, people need jobs. We're not in that, full stage of recession. So he's going to go, like he said, he's going all out, and he's like, listen, I want to keep that inflation, 2%, or less a year, and
Right.
it's really it's scary to a point, but not scary to a point where I would tell people not to buy a house.
Well, I mean, I think it's about perspective also because you only got a couple of options. And that's where, and for my clients and for the audience, that's what I really try to do is let's keep things in perspective. You only got a couple of choices when we're talking about living. Number one,
Hmm.
you can live with somebody. So you can live with your parents, for example. You can be homeless, okay? Or
Yeah.
you could rent. And with renting, there are situations where a person should rent. But if you're renting, you really have no control because after your lease is up, they can kick you out. And then
Yep.
also, that can keep going up, up. And then if you rent, you're paying 100%. That's your interest rate. Your interest rate is 100%.
Yep.
So the only other, I mean, if you wanted to, you can go to jail. Okay. But let's throw that out. Okay.
It's hot and you
Or,
caught.
right. Or you can buy a home. Okay, or you can buy a home. So it's kind of like, yeah, I know if you look at it kind of in a what do they call it? If you kind of look at it in a scope, in a narrow scope, oh, 7%, 8%. Okay. Oh, ooh, ooh, ooh. But if you look at it in totality,
Hmm.
you can live with somebody where you got to put your name on the orange juice. You got to put your oatmeal in a bag somewhere. Okay, so no, so you got to hide it from them so the kids don't get it. Okay,
Yep.
you could do that. You could be homeless. You can pay rent where it's 100%. 8% might not be that bad. So
It's not.
I just want people to look at it in context and not get overhyped by the media. Man, what you think about that?
Oh, that you hit the nail on the head. It's all in what you value, and again, like you said, the perspective. You know, do again, again, like you said, your rent. If when you rent, somebody could kick you out at the end of that year because they need the
Right,
space for somebody else because they want to raise the rent. To you might be paying 2,100. They know they can get 25, and they know you're not gonna pay it. All right, good. You got to get out of here. So do
right,
you grin and bear it? So I'm working on a seminar right now for people that are in the city that are going to be that are like musicians and people that are business professionals that are new in the world and everything like that, college students. Because one big thing for them, they're used to living in dorm life or they're used to sharing space or subletting because they're pursuing their dreams and everything like that. That's great. You can do that and own a property and not have to pay a rent to somebody, and you can still gain a profit from the property that you're getting, even at that 7-8%. Because if you get a multifamily to live in and you rent that out to other musicians or rent that out to other students or something like that in those other units, it'll pay for your own mortgage. So it's real, like you said, it's all in the perspective and how you want to handle and take on life. So you might have to share a house, or again, you could share a multifamily house and get your rent paid for. Like you
right.
said, it's all in its perspective and how you take it, and the opportunity that you see in front of yourself.
House hacking, house
Yep.
hacking, and I mean that's something that we should. I mean, when I was young, man, if I knew about house hacking, I was getting house hacked on. Okay,
Whew.
but at that time there wasn't a name for it. But I lived in a
Uh-huh.
couple of buddies' houses, and I was probably paying for their mortgage. But I didn't know. But
Yeah.
I did not know. So now, I mean, now it's something that's popular and with the internet and so on and so forth. But that's something that I tell, I mean, high and low, man. If you young and you got a job, you should definitely be house hacking out there, man. Regulations wise, have you seen any changes in the regulations lately?
So I won't say in regulation, in the guidelines.
Okay.
So the good thing that the federal government is doing, that the Biden administration is doing, they're trying to make home ownership more affordable for first time home buyers because they know the interest rate market sucks.
Got
So they've done a couple changes in the past couple weeks. So one, they cut the basis point percentage for mortgage insurance on the FHA. Previously, it was at 0.85%. Now it's down to 0.55%. And if anybody doesn't know what FHA mortgage insurance is, it's the insurance that you pay on any FHA loan to the Federal Housing Administration. It's their type of restitution for insuring that loan to the lender. So they cut that amount that you would have to pay as a buyer on that mortgage insurance. So what that does is it makes home more affordable for you because I'll give you for instance, for somebody that was buying a $300,000 house, if your mortgage insurance was $200 a month, that 30 basis point cut might have brought that mortgage insurance down to $125. I'm giving rough numbers again. I'm not giving exacts, but just so you guys can see the impact, $75 can make a difference in your debt to income ratio. And debt to income ratio is how we figure out home affordability. So if we're cutting into something that was a higher cost before, that increases your home affordability. They did the same thing with the VA on the VA funding fee. They cut the percentage for that. So veterans that are buying for the first, buying a home and everything like that. The VA funding fee is a fee that is paid out to the VA, the Veterans Administration, for any buyer that is not a disabled veteran that goes to that administration for guaranteeing the loan. Now they've cut that percentage down, so it's a less cost for veterans that are buying in the market. So homes are more affordable for them. What else did the administration do? They just cut and changed the loan level pricing adjustments on loans. What loan level pricing adjustments are differentials in the interest rate that either charges or gives you a break for different things in the interest rate. So let me make that a little bit more clear for you. So when we look at interest rates, we look at a couple different factors. We look at your credit score, we look at your debt to income ratio, we look at the loan to value of the property, which is how much the house is worth versus how much the loan is going to be for. And based off of those factors, your interest rate cost could be different because they give different hits for each of those things. So if we're looking at a whole percentage point, 0.25% could be, your DTI. They could charge you 0.25 for that. If you have a 740 credit score, they could charge you 0.5%. I'm sorry, 0.50 for having a DTI under 39%. And then those hits is what you get charged for a particular interest rate.
uh, okay.
Okay.
I got you.
So what they did is they changed the loan level pricing adjustments. So people that are first time home buyers that have worse credit scores than people that have, the 740s and the 800s are getting more of a break on those loan level pricing adjustments than people that have better credit. So they're kind of trying to cater to to the first time home buyers and the middle class right now, as far as home affordability and being able to get more people in the home. So that is one good thing that the administration has done. Now, I'll say it's a good thing on my side. Now, for people that have good credit or that are second, buying homes for the second time, not as good because it's causing more of a strain for them to buy a home because their rate isn't going to be that much better than somebody that's a first time home buyer now. Before, again, it was a broad spectrum where, somebody that had a 620 credit score, that, their DTI was maxed at 50%, you were going to get charged a whole ton for that interest rate that you have. Now, they've kind of flipped the script a little bit where they're not getting charged as much, but the people that are better off are getting hit a lot more.
Is that just a FHA loan or that's across the board, FHA and conventional?
That's actually just conventional loan level pricing adjustments that they made. That's for
Okay.
Fannie
That's
Mae and Freddie
conventional.
Mac.
Okay, gotcha. Now,
Yep.
how are they, because that's great, but what I've seen on the other side is that they're requiring more reserves from these first time home buyers. So, for example, back in the day, somebody could just have $5,000 and we get
Mhm.
them enough grants and down payment assistance, and we will be able to go to close all day. But
Mhm.
now it seems like they're requiring more monies from these individuals, basically saying, okay, we understand that you got money to close, but we
Yep.
also want to see reserves also. So it seems like they increase the reserves. Is that just me, or is that something that actually happened?
So that is going to probably be a per lender thing because they haven't raised the guideline on reserves. However, there was a change to what they use to automatically underwrite Fannie Mae and Freddie Mac loans. So because they know we're coming out of a pandemic, because they know that people, were getting by for a little while on, some kind of stimulus, or they didn't have to pay bills for a certain period of time. Um, they want to make sure that people have reserve money because I don't know if you again there was a statistic that went out last year after the pandemic was over and they stopped giving out assistance and everything like that. Credit card debt skyrocketed by 82% because
Wow.
people were going out, during the pandemic and everything like that, and they were, relying on the assistance that they were getting. And then when it stopped, they were like, oh, well, now I got to put everything on my credit cards. So because
Mm,
they see these
okay.
trends and everything like that, they've got to make sure that people that are buying houses are going to have enough money going forward. Yeah, you have money now, but will you have money in the future to make sure that you can pay these payments for the next couple months? So what a lot of the lenders are doing, they're hedging their bets because
Okay.
most people don't know this as well. When somebody gets a mortgage loan, if a person doesn't make their payment in the first 6 months, or they go into
Mhm.
default in the first 6 months on that loan, the lender gets charged back the entire deal. So the
Oh
money that
wow.
the lender made from that deal,
Okay.
they lose if somebody goes into
Mm,
default or doesn't make their mortgage payment. So the lenders are like, all right, great, that's cool. We don't want to lose our money or lose the money that we've made on these deals. So let's require more reserves for people that are a little less, more less financially savvy and don't have a lot of money because we want to make sure that we don't lose the money on the deal. That's where a
right.
lot of that,
Mm,
again, you'll see a certain lenders have extra reserve requirements because they want to make sure that they don't lose their money. And if the person does come on, hard times or something like that, that they'll have something to fall back on and pay the mortgage. Now, I haven't seen it on my side of things. Like again, most of the down payment assistance programs that I go through or I use, they only require 1 month of reserve. So New Jersey program requires 1 month. PHFA, I think their reserve requirement is 1 month still. Um, some of the county grants will, require you to to contribute at least 1% of your purchase price. But I haven't seen an increase in what I've had to get reserves from people. Only people that are if I have to get extra reserves, it's because either they have a shaky credit history or their DTI is extremely high, and that could
okay.
also be what you're seeing as well. If somebody has a higher DTI, reserves are automatically going to strengthen that file because they have something to fall back on. So that's something I always ask people, even if you aren't going to use your pension, if you're not going to use your 401k for your down payment or your closing costs, send me the statements anyway. Because when the underwriter
Right.
sees you have something to fall back on, they're going to say, all right, great. Even though their DTI is high, they've got all this money sitting in this account. So they shouldn't
Mhm.
have any problem tapping them when they get them into a situation. They can say, "Hey, 401k, I'm a little hard up right now. I need to pay my mortgage payment. Can you give me 10,000 to hold me over for a couple months?"
Okay.
Okay.
Gotcha. Gotcha. Now, moving back to the buyer. Um, in your experience, is there one thing that buyers can do as far as to improve their file? And for the public, when I say file, what that is that the buyer situation. So when you get sent the link and you go in there and you fill the application out, that's your application file. And then you're going to send in your W-2s and your pay stubs and your tax returns and so on and so forth. That's your file. So from your stance and from your experience, is there one thing that individuals, or what's the one thing that individuals can do to improve their lending file?
Things that will improve your lending file, and this the first one here is going to be from a strictly administrative standpoint, visually and on a frustration level from the underwriters. Make sure all of your documents are the full page in PDF form and you don't leave out anything. So one of the hardest things in a file is making sure that we have all the proper documentation for somebody and making sure that that document is legible. Because if the underwriter has any question about a document that you send in, if they have any question about a number, if you don't put your employment number on the application for your employer, the address, somebody to contact as far as getting some verification of employment, all of those things, they're not going to deny you from a file, but it's going to lengthen your file, and it could help. It could make you lose out on your home because again, the file gets delayed. So I would say number one thing is documentation. Documentation is going to make sure that your file, if you give us everything that we need up front and we're not chasing you for anything, it's going to make sure that your file is put to the top of the pile versus put to the back of the pile on the underwriting side of things, and that they're going to look at your file and say, "Oh, this is very clean. They gave me all the documentation. It's legible. They had everything we need. Great." From a financial standpoint, when you're filling an application out, be honest about your income.
Mm.
I will have people. I just had one yesterday. A guy put in, he made $60,000 a year, but then he put in he had an annual bonus of $12,000. He put in he got another 15,000 in annual overtime income. And then when we got his pay stubs and his W-2s finally, he was only making $50,000 a year.
Well,
So those little things, again, especially because when a lender is going through a file, we don't pull a verification of employment initially up front. When we're doing an initial pre-approval, we're looking at what you send us and then the W-2s and pay stubs. So if you aren't honest about what your income is, or if you had a bankruptcy, or if you had a foreclosure or something like that, those are the things that are going to again trip you up and cause your file to be a bare, or a not a strong file. um but things that will strengthen it, again, I kind of got away from the initial question. Things that will strengthen the file, having reserves are always
mm,
great. So even if you have somebody in your family that has $10,000 in the bank, even if you don't need that $10,000 in the bank, if they're willing to gift you that money, wonderful, because that gift is going to show that you have reserve money. It's going to strengthen your file.
okay, can I ask one question about that just for clarity? As
Surely.
far as a gift, who can
Yep.
it come from and who can it come
It can't come from a stranger on the street. You can get a
from?
gift from a family member, relative, again, a cousin. It could be a close friend. The relationship has to make sense. It can't, it can come from, you can get an advance from your employer, um, but it's got to be from an entity that is close in your personal life. It just can't come from, Joe Schmo off the corner that said, "Oh, you know what? I want to give you, $10,000. It sounds like you're hard up right now."
Right. Now, one thing that I do have to say, because I just had this happen to me about a gift, is that the gift has to also be traceable. So it has to be
Yes.
verifiable. So when
Yep.
if you give somebody, if for example your father says, "Hey, I'm gonna give you $10,000," they're gonna ask for his bank statements to find
Yep.
out, to make sure that that money isn't being laundered through this particular transaction. I just had somebody
Absolutely.
who, the mother was going to give them the $10,000, but the mother is a conspiracy theory person and she doesn't trust banks. So she doesn't keep her money in the bank. So that was
Okay.
dead on arrival because she would give her the 10,000, but it's not traceable.
Yeah.
So what I told her to do is what she could do, and if the audience, if you run into this situation, then make that money seasonable, meaning put it in your bank account and let it season for 2 months. Is it 2 months or 3 months?
2 months. It's best. So I tell people 3 months because
Okay.
if they put it in for 2 months and they send me their last 2 month statements, I'm still going to see that last deposit that you made 2 months ago. So three
Gotcha.
months, you got to put it in the third month. I'm sorry, the first month, and then go two statements after that.
Okay. And just to explain that a little bit more, is that, for example, just say that you have a mother and your mother does, or a father, and a father doesn't keep their money in a bank. Okay. But
Mm-hmm.
they want to give you a gift. Just say it's January. You would put the money in on January, and then you would wait February, and then you would wait March, and then you would give those two statements to the bank. And to the bank, it's as if that $10,000 is yours.
Yep.
That's correct.
Yep, that is correct, and that goes for you people out there that have cash under your mattress right now. Making a bold statement here. If you have cash in the house, in a jar, in the square jar, in your pillowcase, in the shoebox, go and put it in the bank today. I know you don't like the bank. I know again, you might be one of those conspiracy theorists. Go put it in the bank today. Because 3 months from now, when you need to go buy a home, we need to see that that money is seasoned in the account. If you put it in the account that day, the underwriter will not accept it.
Right.
So you got to have that money seasoned in that bank account. So if you have money in the house now, go and put it in a bank. Go put it in a bank. You know, you can even put tell them, you don't want to touch it. You don't want a card for the bank or anything like that. Go put it in a bank account. Don't touch it. And at least, again, after the 2 months is up, we don't care where it came from after that. We just want to see that it's in the account. If we see the cash going in, you got a problem. But as long as we can't see the cash going in, we don't care where it came from. You could put $50,000 in the bank. Now, again, the bank will probably red flag you, like, where did you get this $50,000 of cash from? But
Right.
us as a lender, as long as it's not within that 2 month period, we don't care where it came from.
And that's funny because I'll have people, they'll complain to me as far as, because the processes are different. You got
Mm-hmm.
some lending institutions, you got some banks where their process is very rough. Okay, very rough.
Mm-hmm.
They're asking you things multiple times, and they're asking for this and asking for that. But again, it's perspective. What I ask people is, when's the last time somebody loaned you $200,000? Or when have they loaned you $300,000? Or when
Mm-hmm.
have they loaned you $100? Okay, probably never.
Yep.
So yeah, I know that they're asking you for a lot of things, and it's becoming a little intrusive. Listen, I understand that, but they're about to give you $200,000 or $300,000. Like, let's keep it in perspective.
Yeah. I flip it around the other way. I said, when was the last time you lent somebody $300,000? And I wait.
Right.
And then I say, all right, you haven't. So what would you need, or what would you ask from somebody to lend them $300,000? And most people will say a DNA sample of, their first child and everything else. I said, all right, so
Right.
we're not asking for all those things.
Right.
We're just asking
Right.
for some paperwork. You
Right. That's
know what I
funny. That's
mean?
funny. Now you personally, I know you moved to a new company, right?
Yeah, yeah. Where I'm at primary residential mortgage now.
Gotcha, gotcha. Now, I mean, what differentiates you guys, I guess, from the other players in the market?
So, and I'm gonna say this: um, there is not a lot of things that differentiate a lot of companies. All
Okay.
of us are playing with the same tools in the
Mm,
sandbox.
okay.
What is going to differentiate is the amount of overlays between companies, the speed of service that you're going to get with companies, the amount of red tape it's going to take to get a loan closed. And that is one of the things that primary residential mortgage does very well. There isn't a lot of red tape around getting a loan closed. There aren't waiting periods as far as, we've got to send this loan through this department, and then we've got to have this loan go through a quality check, and we've got to go this loan go through this, and then you're at a 60-day closing before you know it, because you had to go through so many checks and balances, and it's a simple FHA file. So one of the things that I've seen that I found that primary residential mortgage does well is they get loans closed quickly with care for all people. You know, it's not they're an institution where they're not, you know, trying to reinvent the wheel. We're not super technological or anything like that. You know, we are straight up. We want to give you great service. We want to give you fast service. We want to provide down payment assistance. We want to provide education, and we want to provide opportunity for home ownership for everyone. A couple of the products that I think that are very cool that we have is in the non-QM space of the lending industry. Non-QM means non-quality mortgage. So our non-QM products are pretty special because they open up the market for a lot of business owners and self-employed people. And those products, so we have a product that is a 1 year 1099 only program. So if you're a real estate agent and you just got into the industry last year and you did really well last year as a 1099 employee, we can take that income that you got just that last year as a real estate agent and approve you for a home loan based off of your 1 year of being a real estate agent. If you're a Uber driver and you did really well in Uber last year and you get a 1099 for it, we can use that 1 year of 1099 income to approve you for a home loan. You know, we have a profit and loss loan where we're looking at the profit and loss from your tax returns, but we're not looking at your deductions. So when you're looking at a general tax return, you know, you'll see the profit that somebody makes, and then you'll also see all the deductions that come off of that return, and it brings the income that you actually made down. What we do with that profit and loss loan is we say, okay, they made this much in profit. This is what their expense ratio is. We can approve them based off of their profit and not what the extreme loss was and deductions that they wrote off,
Oh wow.
which is huge for a lot of buyers that are self-employed because you
Right.
know the age old stigma is I got to have 2 years of employment, 2 years of tax returns as a business owner, and
Right.
I can't write anything off. Not writing things off means that I'm going to have to pay the federal government a bunch of money,
Right.
and you know that's going to eat into my savings and da 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 da. Or
Right.
hey, you know, you only made $30,000 on your tax returns over the last 2 years. You can only afford a $200,000 house, even though you made $300,000 last year in profit.
Right.
So that program is extremely huge for getting self-employed people. We have what is called a DSCR loan, which is a debt service coverage ratio loan for investors. And what that loan is, they take the rent for a property that you would buy
Hmm.
versus how much that mortgage payment is. And as long as you're at least at a 1-to-1 ratio, means this equals this, you can buy that home. You just got to put 20% down. So we're not looking at your income. We're not looking at your. We're looking at the credit, but again, your credit score doesn't have to be stellar. You don't have to
Hmm.
have a bunch of extra money in reserve or anything like that. You don't even have to have a job, as long as you
Mm.
have the funds to close and that debt service coverage ratio is equal 1-to-1. We can get you that property.
But that can't be like a house hack where it's owner occupied because it's a 20% down.
It's a 20% down. So again, you can buy a multifamily with the property. But
Mhm.
again, it's got to be in the scope of you're buying an investment property. So if you're buying that property
Right.
to invest, that's fine.
Okay.
You can put that 20% down. You can still live in it, but again, you've got to buy it with the primary intent of using it as an investment.
Gotcha. Gotcha. All right. No,
Okay.
I totally understand.
Yeah, there other program again we had and a lot of people again like I said they have these loans, we just do them very well. Our I-10 loan is one of the best out there.
I
I-10
can. What's
is
that?
it's an I-10 number is for somebody that has come into the country and they don't have a social security number yet. So they
Mm.
assign people they call it an I-10 loan. It's an identification number. And what it does is allow people that aren't U.S. citizens to buy property in the United States.
Oh,
So
wow.
they don't even have to have a credit score. Um, as long as they have income and the money to put down, they can buy a residence in the United States. And again, for a lot of people, a lot of lenders out there on a traditional side, they can't buy with a traditional loan, and they think that they have to rent. So you get into this situation in a lot of communities where you'll see 7 or 8 people living in one property because that
Right.
person they have one person that's established a social security number, and they've established credit and stuff in the United States, so they're all living in that space. But now we've got into a point where those people that are here and they're living, they have the savings, or they can get gift savings from another family member. As long as they've had
Mhm.
a job and everything, like they have the income, we can get them a property even without the credit score.
Nice, nice, man. Well, listen, man, you gave us a lot, man. You definitely gave us a lot. Why don't you tell people where they can find you?
You can find me on Instagram. I'm the Vocal Mortgage Mogul on there. That will be changing shortly. Facebook, I am Drew Thompson. My Facebook business page is Drew Thompson, originating branch manager with PRMI. And again, you guys can always call me. My phone number is 609-724-4930. The phone is always on. So, feel free to reach out to me anytime. My email address is drew@primeres.com.
Res.com. All right, y'all. And this is Colin Nathan Aleem, the real estate boy. If you're looking to buy a home, sell a home, or invest in real estate, I got you, Drew.